Based on an analysis rooted in the true meaning of the proverb, "cannot see the forest for the trees," we provide an image of the foreign exchange market for practitioners involved in currency portfolios. Here, we measure the currency pressure trends in the foreign exchange market by measuring the currency-specific selling or buying pressure on the market and organize 50 global currencies using PTN correlation. You can see that market pressure is comprised of the correlations of major currencies: US dollar, euro, pound, Chinese yuan, and Japanese yen in 5 tables, and the correlations of 45 minor currencies, including Bitcoin and gold prices. Furthermore, each chart allows you to check the PTN correlation of exchange rate pressure, which is the differential pressure of the currency pressures of the pairs that make up the actual rates. Now, we present the FX market response, updated on April 27th. In addition, URLs for free download and enlargement of the 5-table files are provided in the details section below the video. Specifications and supplementary information for this item are also listed. Please feel free to use it.
Here are 5 key points to understand the content. I. Currency Pressure Index, RX, selling or buying pressure in the market for the currency in question. 2. Exchange Rate Pressure Index Pair, RXP, the pressure difference between two currencies, PTN correlation. 3. Correlation, PTN1, sell and sell, PTN2, buy and buy, PTN3, sell and buy. 4. Chart line display, selling in the upward direction, buying in the downward direction, pair, market/RX. 5. Chart time series, irregular x-axis, 16 measurements from the last weekend of the past 12 months and the most recent 4 weekends.
Here, we focus on the weekly pressure for the previous week based on the data collected at the end of the previous weekend. In the table chart, this corresponds to the measurement at the far right of the x-axis time series. In the statistics on the right side of the table, the aggregated results are shown in the flow statistics at the bottom. Chart 1 shows that the dollar Lindex was bought last week. Charts 2 through 5, major Lindex, show that the euro was sold, the pound was sold, the yuan was bought, and the Japanese yen was sold. The pressure correlation of major currencies against the dollar was PTN2 only for the yuan, while PTN3 included 3 currencies: euro, pound, and Japanese yen. Charts 6 onwards, minor currencies against the dollar, showed pressure correlations of 19 currencies for PTN2 and 26 currencies for PTN3. The dollar's buying pressure was assisted by the selling pressure from the euro, pound, and yuan. Here, we focus on the weekly pressure for the previous week based on the data collected at the end of the previous weekend. In the table chart, this corresponds to the measurement at the far right of the x-axis time series. In the statistics on the right side of the table, the aggregated results are shown in the flow statistics at the bottom. The Euro Lindex in Chart 2 saw selling pressure last week. In Charts 1 and 3 through 5, major Lindex, the dollar saw buying pressure, the pound saw selling pressure, the Chinese yuan saw buying pressure, and the Japanese yen saw selling pressure. The pressure correlation of major currencies against the euro was PTN1 only for the pound, while PTN3 included 3 currencies: the dollar, Chinese yuan, and Japanese yen. The pressure correlation of minor currencies against the dollar from Chart 6 onwards was PTN1 for 26 currencies and PTN3 for 19 currencies. The selling pressure on the euro may be a sign of improvement in the long-standing buying pressure on the euro and pound due to repatriation. Here, we focus on the weekly pressure for the previous week based on the data collected at the end of the previous weekend. In the table chart, this corresponds to the measurement at the far right of the x-axis time series. In the statistics on the right side of the table, the aggregated results are shown in the flow statistics at the bottom. Chart 3 shows that the pound index rose last week. Charts 1, 2, 4, and 5, major index, showed buying pressure on the dollar, selling pressure on the euro, buying pressure on the yuan, and selling pressure on the Japanese yen. The pressure correlation of major currencies against the pound was PTN1 for the euro and PTN3 for the dollar, yuan, and Japanese yen, 3 currencies. Chart 6 and beyond showed pressure correlations of minor currencies against the dollar. PTN1 had 26 currencies, and PTN3 had 19 currencies. The selling pressure on the pound may be a sign of improvement in the long-standing buying pressure on the euro and pound due to repatriation.
Here, we focus on the weekly pressure for the previous week, based on the data collected at the end of the previous weekend. In the table chart, this corresponds to the measurement at the far right of the x-axis time series. In the statistics on the right side of the table, the aggregated results are shown in the flow statistics at the bottom. Chart 4, the RMB Lindex, saw buying on dips last week. Charts 1, 2, 3, and 5, the major Lindex, showed buying on dips for the dollar, selling on dips for the euro, and selling on dips for the pound and Japanese yen. The pressure correlation against the RMB for major currencies was only for the dollar in PTN1, and for three currencies, euro, pound, and Japanese yen, in PTN3. The pressure correlation against the RMB for minor currencies from chart 6 onwards was 19 currencies in PTN1 and 26 currencies in PTN3. The buying on dips for the RMB is simply a continuation of the previous dollar-backed system. Here, we focus on the weekly pressure for the previous week based on the data collected at the end of the previous weekend. In the table chart, this corresponds to the measurement at the far right of the x-axis time series. In the statistics on the right side of the table, the aggregated results are shown in the flow statistics at the bottom. Chart 5, the Japanese yen Lindex, saw selling pressure rise last week. Charts 1 through 5, the major Lindex, showed buying pressure on the dollar, selling pressure on the euro and pound, buying pressure on the yuan, and selling pressure on the Japanese yen. The pressure correlation between major currencies and the Japanese yen was PTN1 for the euro and pound, and PTN3 for the dollar and yuan. Chart 6 onwards, the pressure correlation between minor currencies and the yuan was PTN1 for 26 currencies and PTN3 for 19 currencies. The selling pressure on the Japanese yen should be seen as an overheating of structured yen selling. This is different from the situation with the euro and pound.
The pressure correlation of major currencies last week appears to be a dollar-led movement, assisted by European currencies. Until 2 weeks prior, the dollar Lindex saw selling pressure, followed by a reversal of buying pressure last week. The important point is that this reversal of buying is not due to the stalled ceasefire talks with Iran or the ongoing double closure of the Strait of Hormuz. The current dollar buying is due to reports last week of increased and reaffirmed liquidity injections by the Federal Reserve and the U.S. Treasury. While the U.S. is experiencing rising prices for domestic gasoline and other fuels, it is the world's largest oil producer and, more than being fully self-sufficient, exports U.S. crude oil to countries that cannot import Middle Eastern crude. This, combined with an increase in the money supply, will naturally lead to inflation, but at the same time, it will ensure the sustainability of wages and employment. In other words, the U.S. economy is heading towards another golden age. On the other hand, countries that cannot secure as much crude oil as the Middle East will naturally experience inflation due to oil shortages. However, this will not allow them to maintain wages and employment. Conversely, this leads to stagflation, where production is adjusted and costs, including wages, are cut. In other words, foreign companies that have entered or are planning to enter that country will sense that the yield on their local operations is deteriorating, leading to the cessation of operations or the withdrawal of funds. This results in capital flowing out of that country and back to the home country. This means that selling pressure will intensify in that country. Naturally, the currency to buy will be the currency of a country that does not have an oil problem and whose economy responds to monetary easing. This is why I conclude that the dollar is currently being bought. Japan is also experiencing a similar structure in which the weak yen is structurally entrenched. The decline in national purchasing power and inflation are, if anything, stagflation. Recently, the Prime Minister and former Ministry of Finance officials have begun to manipulate public opinion to portray a weak yen as a good thing. Globally, a country that cannot cut taxes is considered a bankrupt state. Even the U.S., despite its massive government debt, implements tax cuts. The EU is the same. Next, let's talk about countries that must sell their oil. That's right, the oil-producing countries of the Middle East and the Persian Gulf. They have run their nations on oil revenue. The blockade of the Strait of Hormuz, which eliminates a country's oil revenue, is, in a sense, a form of economic sanction. With the exception of Iraq, The Gulf states are all pro-US. Then, suddenly, the US attacked Iran, and Iran retaliated against US military bases in the Gulf states. And then, suddenly, the US, the very country Iran relied on, blockaded the Strait of Hormuz. This has led to a tightening of Iran's blockade of the strait. It seems the world can be divided into three categories: countries that must sell oil, countries that must buy oil, and countries that are completely self-sufficient and unaffected. And the country that started this war is a completely self-sufficient oil country. And the key to a ceasefire and the liberation of the strait lies with that self-sufficient country. In other words, it's not an exaggeration to say that the US is imposing sanctions on non-cooperative allies through the blockade of Hormuz, rather than pursuing a ceasefire with Iran. I propose this situation as the three oil nations theory. Needless to say, the consequence of this logic is a stronger dollar. Please excuse the rough writing style.
Thank you for watching. Have a wonderful week. This has been Taro Tanabe reporting from Japan.